All right. Let's do a recap on Thursday's trade and let's look at the reason why I took this, and then we'll go over the entry and explain the exact entry. So, first of all, we had a bullish bias on the day. We were trading in this 15-minute fair value gap, and you can see that price had returned from this low. So, you take the last low and you put it on the last high, which is right here. Price then retraced below the 50% mark of this line right here. That is 50% right there. Price return into the discount range. It then respected PD array in this range, which is the 15-minute FVG. Well, apparently I can't spell. Okay, so it came down here and it respected this 15-minute fair value gap. So now we're looking for an entry on the 1 minute. Actually, I'll mark the macro in for you as well because we were in the second AM macro New York session. We had price come up and we have a small market structure shift right on this candle right here. Price then returned and swept these lows right here, right before this macro inside here. So we have a sweep of liquidity right here. So you have a market structure shift. You have an internal sweep of liquidity right here on this candle. And you also have a bullish PD array, this 15-minute fair value gap, which is this whole blue box right here on the 15-minute. After an internal sweep, we fill this fair value gap right in here. This was a bearish gap, as you can see. Now, it's not necessary to have this bearish gap filled, and it fills with the body of the candle right on this candle right here. Okay, but this is definitely confluence. Market wants to go the other way. So you have your market structure shift, you have an internal sweep of liquidity, you also have another market structure shift right here on these highs. Oops, right on these highs here. You have two market structure shifts. And then you have our entry. And the way I justified this entry here was we had this temporary high right here. And then we have this temporary low that was made right here. So the temporary high in this range is this candle right here. So that is your mitigation block on this candle right here, because you have this high, it made a low here. Now it made another high. You got your high of the range here. You got the low of the range right here. And you have the high right on that candle. We'll call it the green candle to make it easier for everybody right here. And because this low, which is the temporary low, because it did not make a new low, this is the mitigation block here. So we have this right here. So now you have the price blow through it with this displacement candle right here, and this displacement candle over this breaker right here. So this is our entry right here. Our stop placement was below this wick right here, right? So a 29-point stop. And I had a target of 60 points, which is right here. Getting out before this bearish value inside here. Wanted to secure a 1 to 2 on this trade. And there we go. That is Thursday's trade recap, which is the Unicorn Model, ICT. I also want to show in this trade how the draw on liquidity was on the 15-minute, and there was these equal highs up here. So here you can see the equal highs right here, and they're old equal highs of Tuesday. So I took a 1 to 2, which is 60 points, 60 handles down in here, when I could have let this range ride out to about the high, which was up here, and I would have gotten 137 handles. But price is a little bit unpredictable in the summertime. So I wanted to get my 1 to 2 and be out for the day. I wanted to avoid something like it coming up into this fair value here, into here, coming down, stopping me at a break even, and then going to take these highs here. And there you have it. Trade recap, unicorn model.